Good afternoon, everyone. My name is Eric Zurin. I'm the CEO of Shanta Gold. Shanta is a East African gold producer that is in its 6th year of gold production in Tanzania. For the year of 2018, we're guiding to produce 82 to 88,000 ounces at an all-in sustaining cost of $680 to $730. Our market cap is $60 million, and I'm going to take you through today and tell you why I think it's an interesting time to be looking at Shanta, and also cover our priorities for 2018. First one being to continue the operational excellence. Number 2, to repair the balance sheet once and for all. And number 3, to focus on very targeted growth. So we'll cover those today. Shanta is blessed with a high-quality, low-cost asset. As you can see on the page here, our all-in sustaining costs are industry-leading. We have just about 500,000 ounces in our reserve, which at this cost level and margin, where the gold price is today, will generate significant cash flow. And we'll tell you a bit about what we're going to be doing with that cash flow today. A lot of hard work has gone into this guidance for this year, particularly across the cost improvements and efficiencies that we've extracted over the last couple of months. What does this mean financially for Shanta? Well, in 2016, we generated $50 million of EBITDA. This year, in 2018, we don't guide on EBITDA, but if you do the math of 82 to 88,000 ounces at an all-in sustaining cost of $680 to $730, you'll probably get to around $50 million of EBITDA again. Now, that's a lot of cash flow for a junior with a market cap of $50 million, which is why we think it's pretty exciting. Without a doubt, we'll be pretty careful with that cash flow because we have a responsibility to manage it well. Now, the good news is that our second priority for the year is debt reduction and balance sheet improvement. The better news is that we've started to improve already, going from Q3 last year to Q4. We saw our net debt drop to about $40 million, and our cash go up to about just under $14 million at the end of 2017. That's a good story, but the story gets better with the cash flow that we're going to be generating. It's very important for us through 2018 to be deleveraging the balance sheet and eliminating that debt once and for all through to 2019. Now on to what I think is the more important metric to be looking at, which is the free cash flow. In 2018, we guide here for $16 million of capital. Now the reason we can do that versus our EBITDA of around about 50 million at today's gold price is because we have very well invested assets that we've spent a lot of money and time putting in place, as you can see here on the page. In 2016 and in 2017, we invested nearly $100 million in these assets. We have a very high quality underground mine. We have our power in place for the next 20 years. Tailings facility, which is due to be commissioned in the next couple of months. And our water, which is well in place for a very long time, provided we take care of that. So all this translates into high cash flow, low capital, and debt repayment, including cash build over the 2018 period. Now, what does all that get you? Well, on the left-hand side of the page, on the reserve case only, the most conservative bankable case, at today's gold price and a 10% discount, you're looking at two times the net asset value versus our current share price. We think that's pretty attractive. Now, if you move to the right-hand side of the page, you'll see what we think is even more exciting are some of these upsides to the existing base case that we refer to. And I'll take you through some of these on the right-hand side and why we think these are pretty good catalysts to be carefully watching over the next period. Some of the things we'll be doing this year, as mentioned, priority number 3, targeted growth. We will be drilling at our second asset. Now this is very targeted drilling. We're looking at a small amount of 2,000 meters which would just be less than about $250,000. We'll be doing that in the next couple of months and updating the market on that. And the reason for that is that that gives us a bit more confidence on what we will do with the second asset as we develop it. We'll also be expanding and testing our down dip extensions at our flagship asset called New Luika. We'll be doing that towards the middle of the year. And that's pretty exciting because that's a very small amount of drilling that we're going to be committing to. And our thesis shows that we'll have we hope, have a pretty good conversion rate from resource to reserve, which goes a long way in terms of our evaluation. Now here's a bit about where we'll be focusing. This is at our Bohemia Creek. This is our crown jewel, so to speak. This is a high-grade underground mine at the moment. We've just gone underground last year. Now what you can see in the pinks and the purples here is 6 gram material. So we are currently mining greater than 6 grams from the underground, and we'll be doing so for at least the next 6 years across all of our underground deposits. What we think is exciting is what happens beyond the reserve case. So you can see here the potential down dip extensions. When we'll be testing those, the potential there is that the mine life extends and our thesis is proven correctly. Now that's exciting because all the capital is already invested, and this gives us the potential for pretty interesting IRRs by expanding that resource into reserve. We'll be doing that next, as I said, in the middle of the year. Here's Luika. This is the second underground deposit. It's probably ranked third in terms of priorities from underground. But again, the reserve case is pretty limited in terms of the mine plan, and we'll be testing what's outside of that reserve case throughout the year. And finally, Alunga, which is, again, in the same vicinity, within 2 kilometers. We've mined the open pits, and we'll be testing, again, below the underground reserve to test the extension at depth. All of these are the upside to that reserve case I outlined earlier. Now, Singita, this one is pretty interesting. It's the second asset in our portfolio. It's been in our portfolio for about 15 years. It's rare. It's rare because it has mining licenses. It's permitted. Resettlement's completed. Recovery testing is being done. We have a camp in place. We have a team there, and we have a resource. We declared late last year 728,000 ounces. Now, we've gone and done the work in terms of optimizing that resource, and we believe there's a mine life of at least 6 years of 30,000 ounces. That's a very attractive project for us as a second asset in our portfolio, and we'll be looking at asset level financing that this year to unlock value for shareholders. Sustainability is important, particularly in a place like Tanzania these days, where without a doubt our government relations are very strong. Our scorecard, in fact, tells us that because we received the most VAT back in November of all the mining companies, and we got it the first. So we were pretty happy about getting that $3.5 million back. Clearly, the government wouldn't be giving it to us if they didn't like us. Part and parcel with that is that sustainability effort, partnership in country, focusing on doing things differently, and from our perspective, investing in the right places and not just splattering sustainability dollars into the ground. So it's been successful. As I said, we've been in Tanzania since before 2005 when we listed, and the relationships are very well formed around the country and around where we operate. And then finally, the capital structure. We have, I would like to say, a blue chip register of financial investors out of London. Very smart individuals that have followed the company for a while and continue to be supportive of Shanta. Fundamentally, a lot of value for us in the cash flows we generate, the mine extension that we have, and the balance sheet repair that we'll do this year. So it's looking pretty exciting for us. You can see there on the right-hand side the debt. Hopefully when we present next year, there'll be far less debt to cover in that table as we move to a net cash position. So yeah, thank you very much, and appreciate your time.